Morning, guys. It's Wednesday, May 14th, 5:24 a.m. Central Time. Grain markets are mixed this morning. July corn futures down 1 at 441 and a half. July soybeans up 3 1/4 at 1075 and 3/4. July Chicago wheat down 1 3/4 at 515 and a half. July Kansas City wheat down a half cent at 511 and a quarter. July spring wheat down 4 3/4 at 576. We've got some weather news to start off with today. Let's go there.
So, widespread rainfall is forecasted for most of the U.S. Corn Belt. A system sits over western portions of North Dakota and South Dakota early this morning. Accumulation via a separate system will begin in the eastern Corn Belt by Friday. The 5 to 10 day period introduces more rain for more areas, while the 10 to 16-day period introduces rain for even the driest areas of the western Corn Belt.
Mackenzie, you're in Nebraska, and I
Yes.
told you about the forecast this morning. I said, "Hey, it's going to rain in your area," and you're kind of like, "Yeah, f you, Joe. I'll believe it when I see it."
Yep.
And it is an extended forecast. Is it to be believed? I don't know. Just to be thorough, I threw in some extra maps here. So here's the euro, and the trolls will say, "Joe, the euro's better than the GFS." It says the same damn thing. So why has the corn market been down and out here the last few days? We had a friendly USDA report, right? Well, a lot of the talk regarding drought, and there's been a lot of drought chatter. There could be a drought this summer. I don't really do the drought chatter. It's just there's drought chatter every year. It seems like it's a little bit louder this year. It's focused around the Western Corn Belt because where has it been dry? Nebraska, Western Iowa, South Dakota, into parts of North Dakota, into parts of Minnesota. Those areas are slated potentially to see a whole bunch of rain here during, and when I say a whole bunch, I mean you go back and you look at the specific totals, you're talking 1.5 to 2 inches, maybe 3 inches of rain in parts of Nebraska, Western Iowa, Dakotas. Some pockets could be a little bit heavier, but that'll be kind of outside of key corn and soybean growing areas. But anyways, you have this kind of narrative floating around that there's going to be this Western Corn Belt drought. And maybe with this weather forecast, that sort of idea is maybe slightly off the table ish. Now, rain in late May does not make a corn or soybean crop by any stretch of the imagination, but it does perhaps eliminate some degree of risk in the minds of traders. So I mentioned yesterday when we talked about this, why is the corn market acting poorly? Is it because the trade thinks that bigger acreage is coming? Yeah, I think that's maybe one possibility. What about the rains forecasted for the Western Corn Belt? I think that's another possibility. The other thing that I'll mention is that I think there is a contingent of the trade who believes that USDA is understating old crop U.S. ending stocks, perhaps because they're too high on the feed number, or maybe they're still wrong about last year's crop. There's just some things that don't jive necessarily. Like you got this projection for this tight old crop carryout situation. It just doesn't seem to line up with what's going on in the marketplace. Maybe this is one of the reasons. I've got one more map I'll show you here. This is from our friends at Crop Profit. This is expected rainfall totals versus normal over the next 14 days. And they have it broken out by state and percentages. So Nebraska over the next 14 days is expected to see 113% of its normal rainfall based on Euro model data. South Dakota, you're talking 200 and something percent of normal rainfall. North Dakota, even wetter than that. Iowa will see above normal rainfall, and most of that's going to be in the western part of Iowa where it's been dry. Minnesota also will see above normal rainfall. So this could be one of the many reasons, perhaps, that corn prices have acted very, very poorly.
House committees have proposed changes to the 45Z tax credit and biofuels funding as part of a budget reconciliation package. The Ways and Means committee's proposal would limit 45Z credit eligibility to fuels only made with feedstocks sourced in the US, Mexico, or Canada. It would also revise how greenhouse gas emissions are calculated by excluding emissions linked to indirect land use changes. In addition, the proposal would extend the 45Z credit through 2031 and bar foreign influenced entities from claiming it. The Energy and Commerce Committee's proposal would eliminate Inflation Reduction Act funding that supported the EPA's work on the renewable fuel standard. Biofuel advocates have praised the proposed changes, saying they could drive innovation, attract new investment, and support job growth in rural communities.
This sounds good. There are some good things. One thing that's missing that I would have liked to have seen is language regarding sustainable aviation fuel and corn ethanol. It's totally absent. We've seen no guidance, no policy, none of that. What is of consequence, perhaps, is the elimination of foreign feedstocks. So they're still talking about, okay, you can use feedstocks from Mexico and Canada, still get the credits. The one thing that would be excluded, I believe, based on this language, would be your used cooking oil from China. And we've ran several stories about that over the last year or two now, about how that's kind of taking the place of soybean oil in a lot of biofuel production. So the soybean oil market has acted very positively, reacted very positively to this, and posted fresh calendar year highs just yesterday, I believe, on this biofuel optimism. And this has helped to strengthen the soybean market. The soybean market has been led by the bean oil market. Now, the old timers will tell you that you would like to see a meal-led rally. A meal rally is a real rally, but in this sort of environment, we will take any sort of rally that we can get.
The Iowa Senate has passed legislation that limits the use of eminent domain for carbon capture pipelines. On Monday, the chamber passed House File 639 in a 27 to 22 vote. Numerous senators attempted to alter the bill through amendments, however, none were adopted. The bill now awaits Governor Kim Reynolds' signature. The legislation redefines what qualifies as a common carrier, increases insurance requirements, and expands public input in the Iowa Utilities Board's permit process. For years, the Iowa House has advanced similar measures, only for the Senate to reject them. The bill's passage adds further uncertainty to the future of Summit Carbon Solutions' proposed $8.9 billion carbon capture pipeline.
Yeah, at the Summit Carbon headquarters, they're pushing the panic button again because they've got so many problems with this legislation. I know that a lot of people hate eminent domain. Not in my backyard. I don't want it. But at the same time, a lot of people do want these carbon pipelines. It's a contentious issue, to say the least. There's definitely some money in it for some landowners, but some landowners would never want to see this stuff. I understand both sides of it. But again, we ran two stories today, basically, that still, like, this corn for jet fuel thing, it just doesn't look like it's happening anytime soon.
If you guys have not checked out our premium content, you sure need to do so. Joe, can you tell our viewers about yesterday's premium video with Pete Meyer?
Pete Meyer, professional analyst and advisor to the funds, was on with us yesterday. And we actually talked about this biofuel stuff a little bit more in depth. Pete gave us his 2 cents on the whole thing. We talked about the eminent domain issue. We spent quite a bit of time dissecting the USDA report. If you want to listen to a veteran market participant and analyst talk about the market, somebody who is much, much, much smarter than me, you should listen to the stuff that we do with Pete. This was a shorter one. I think it was only 25 minutes. Usually we do like 45 minutes to an hour with Pete. It's totally uncut. There's no commercials, nothing like that. As I've mentioned to you guys a million times, we don't have any sponsors. You guys are our sponsor. The premium subscribers are our sponsors. Premium subscribers are the only way and reason that we're able to do this. We lose a whole bunch of money doing the podcast and the YouTube stuff. We don't make any money off this. The premium subscribers keep us afloat here. If you guys would like to see the premium content, we only post a fraction of what we produce here on YouTube or on the podcast. There's a ton of stuff that you're not seeing. And if you're a decision maker in your agricultural operation, the paid stuff is what you really need to see. That's what will help you to make decisions. We do everything from cash grain marketing to capture and carry to crop insurance to weather to policy, all of those things. You can go to standardgrain.com. You can sign up this morning. It's a $50 per month subscription. You can cancel at any time. There's no other fee. There's no other obligation. Nobody will try to sell you anything else. We'll never sell your information. We just want to send you our information for $50 a month, and that's it. Give that deal a shot this morning, guys. I know you're busy. You can sign up on your phone. If you're in the truck or tractor, or whatever, it takes about 30 seconds to do on your phone with Apple Pay or Google Pay or Cash App or credit card, whatever. So give that deal a shot. I'll forward you a copy of this morning's email.
Brazil will likely maintain its dominance in the Chinese soybean market, even with the temporary tariff cuts between the U.S. and China. Thanks to a record harvest and the absence of Chinese tariffs, Brazilian soybeans remain more competitively priced. U.S. exports still face a 10% tariff even after the recent tariff cuts, putting U.S. farmers at a disadvantage. Some farmers claim the trade truce doesn't resolve underlying trade issues, such as the U.S.-China trade deficit. They also worry that the current pause mirrors previous failed efforts to boost agricultural trade with China. Adding to the uncertainty, the truce will expire just as U.S. farmers begin their harvest. This timing has made Chinese buyers cautious as they remain unsure of what will happen when the pause ends.
Okay, let's be clear about one thing here, and I have a couple charts that will illustrate this. Yes, the U.S. has lost its place as the dominant global soybean exporter, and Brazil has taken our place. That has nothing to do with tariffs. It has nothing to do with Donald Trump. It has everything to do with the fact that Brazil is just producing more and more and more and more soybeans every single year, while U.S. soybean production has basically flatlined and has not increased since 2015, 2016. We've flatlined in terms of production for 10 years, and we're probably not going a hell of a lot higher. And that has resulted in drastically higher exports from Brazil and stagnant exports from the United States. This has everything to do with supply and demand and very, very little to do with the current tariff or policy landscape. That's all it is. So I know that the media wants to turn this into, oh, we're losing share because of Trump or whatever. And that's not necessarily what this article said, but there's a lot of articles that have said that. And that's just not the case. The reality of the situation is Brazil has just become the dominant producer, the dominant exporter because they're a dominant producer. And it's kind of pushed the U.S. out of the export market to some degree.
China is forecasting a decline in soybean imports. Imports for the 25-26 season are projected to fall to 95.8 million metric tons, a 2.8% decrease from this season's estimated levels. The decline is attributed to reduced soy meal use in livestock feed. The Chinese government recently announced plans to lower soy meal share in animal feed to 10% by 2030, down from 13% in 2023. Meanwhile, domestic soybean production is forecast to rise by 2.1% during the upcoming season.
All right. So USDA says that new crop China soybean imports will be 112 million metric tons. And China says that they'll be, what was it, 95.8?
Yep.
It's only a difference of 595 million bushels. What's that between friends? It's only like double the U.S. carryout. This is not abnormal, though. Like, there's always a big difference. I think for some reason, the Chinese government, as honest as they are, I think that they sometimes understate their demand for things like soybeans for obvious reasons. Hey, we don't need that many beans. Let's just keep the price down. And then they buy a whole bunch. I don't know. I know that USDA's office in China is not as optimistic as the WASDE board. The WASDE board's got the number for new crop at 112, which may be lofty. I don't know, but it's a marketing year that hasn't started yet. We don't know for sure.
Inflation has fallen to its lowest level in over 4 years. The Bureau of Labor Statistics reported Tuesday that the Consumer Price Index rose 2.3% year over year in April, the lowest annual rate since February 2021. Economists had projected a 2.4% rise. On a monthly basis, CPI increased 0.2%, lower than the expected 0.3% increase. Shelter costs remained a key contributor, climbing 0.3% from March. Despite the recent slowdown, economists anticipate inflation could rise in the coming months, even as the U.S. has temporarily reduced its 145% tariff on Chinese goods.
If you go back and look at like a corn chart or a soybean chart, we rallied actually out of Trump's called Liberation Day in early April when the tariffs were slapped on. And I think that part of that rally, maybe looking back, a significant portion of that rally had to do with inflation fears. And when the trade war was at its hottest, there was fear that it would result in inflation. And now that the trade war is dissipating and you've got agreements or truces in place, that inflation fear is not out there, and you've got a lower inflation print last month. So that was a story, I think, in the grain markets for sure, especially in hindsight. In real time, it's very difficult to call this stuff, of course. So 2.3% annualized percent change in CPI is the lowest rate since February of 2021. Make no mistake, however, the basket of goods and services that CPI tracks is as expensive as it's ever been. So no, things are not getting cheaper. Egg prices are down, I read, but no, in total, the basket of goods and services that CPI tracks is the highest that it's ever been. It almost never goes down. It'll go down maybe for a minute if you have a recession or something, but that's about it. Everything continues to get more expensive over time, as you know. Following this data, the S&P 500 traded higher and as of yesterday's close was higher for the year. The current Treasury market setup would indicate that we're going to see a couple of rate cuts prior to year end. The current Fed fund target rate is 4.25 to 4.5. We should be, or could be, closer to 3.75 to 4% by the end of the year. What did cattle do yesterday?
Cattle futures were mixed. Live cattle were 50 cents lower to $1.17 higher. Feeders were 37 cents lower to 67 cents higher. Box beef was also mixed. Choice was up 196 at 350.10, while select was down 76 cents at 334.47.
And now that it's possible that it's going to rain in the Western Corn Belt and in the West 2 weeks from now, the cattle market's fundamentals will be fixed, right?
Oh, everything will be fixed. We just need a good 6 inches of rain and we'll be ready to go.
Yeah. All right. Outside markets are pretty quiet this morning. Stocks are mixed. Treasuries are up just a little bit. U.S. dollars off. Crude oil is down 68 cents in the June WTI at $63 even last trade. Have a great day, guys. We'll be back on Thursday.